Hi guys, welcome to my channel. So before we get started, make sure to hit that like button. Also subscribe to my channel. In this video, we will talk about the top 5 investment scams to avoid now. So make sure to watch the full video. 1. Ponzi schemes. A Ponzi scheme is a type of investment scam in which the returns promised to earlier investors are paid using the investments made by new investors rather than through legitimate profits. The scam is named after Charles Ponzi, who became infamous for using this scheme in the early 20th century. The Ponzi scheme works by luring investors with the promise of high returns in a short period of time. The scheme usually starts with the promoter, or the Ponzi operator, convincing a few investors to invest their money. Once the Ponzi operator receives this initial investment, they use the money to pay high returns to the initial investors, often as much as 20% or more per month. To attract more investors, the Ponzi operator may use tactics like advertising or word of mouth to promote the investment opportunity. The operator will promise high returns to new investors and pay out those returns using the money from the earlier investors, creating the illusion that the investment is successful and legitimate. Eventually, the scheme will collapse when the operator can no longer attract new investors or pay out returns to existing investors. At this point, the operator disappears with the remaining funds, leaving investors with substantial losses. Ponzi schemes are illegal, and investors who participate in them can lose all of their invested money. To protect yourself from this type of investment scam, always do your due diligence and research the investment and the company offering it, and be wary of investments that promise high returns with little or no risk. 2. Pump and dump schemes. Pump and dump schemes are a type of investment scam that involves artificially inflating the price of a stock and then selling it for a profit, leaving investors with significant losses. The scheme typically involves a group of fraudsters who work together to promote a particular stock and then sell their shares when the stock price reaches a peak. The process of a pump and dump scheme starts with the fraudsters purchasing shares at a low-priced, thinly traded stock. They then use various tactics to artificially inflate the price of the stock, such as spreading false information about the company through social media, email, or telemarketing. This information may include claims of impending news or events that will increase the stock's value, even if those claims are completely false. As more people buy the stock based on the fraudulent information, the stock price begins to rise, attracting more investors. The fraudsters then sell their shares at a profit, causing the stock price to fall sharply. This leaves the remaining investors with significant losses. Pump and dump schemes are illegal, and investors who participate in them can lose all of their invested money. To protect yourself from this type of investment scam, always do your due diligence and research the stock and the company offering it. And be wary of stocks that are heavily promoted with little to no information about the underlying business fundamentals. Additionally, investors should never make investment decisions based on unsolicited emails or phone calls, and should only deal with licensed financial professionals. 3. High-yield investment programs, HYIPs. High-yield investment programs, HYIPs, are investment scams that promise high returns on investment, ROI, with little or no risk. These scams are typically promoted through social media, email spam, or online forums. HYIPs usually claim to invest in various high-risk ventures such as forex trading, real estate, or cryptocurrencies, and offer returns of 1 to 2% per day or even higher. They often have complex compensation plans that involve referral commissions, bonuses, and other incentives. The problem is that these programs are usually fraudulent. They may initially pay out to investors to build trust and encourage them to invest more, but the payouts are typically unsustainable, and the programs eventually collapse, leaving investors with little or no return on their investment. HYIPs use various tactics to make their schemes appear legitimate. For example, they may create fake testimonials or post false information about their investments on social media or other websites. They may also claim to be registered with financial regulatory authorities or have partnerships with reputable financial institutions. In reality, HYIPs are often run by anonymous individuals or criminal organizations, and the investments are not regulated or insured. Investors who participate in these programs risk losing their entire investment. It is important to be cautious when considering any investment opportunity and to research the investment thoroughly before committing any funds. High returns with little or no risk are typically too good to be true and should be viewed with skepticism. 4. Offshore investing. Offshore investing can be a legitimate way for investors to diversify their portfolios and potentially reduce their tax liabilities. However, offshore investing can also be used as a cover for investment scams and frauds. Offshore investment scams typically involve a promoter or broker who offers high returns on investment in offshore funds or companies. These investments are often advertised as being outside the jurisdiction of regulators and tax authorities, making them seem more attractive to investors. The problem is that these offshore investments are often fraudulent. The promoter may use false or misleading information to convince investors to invest in companies or funds that do not exist or have no real assets or operations. In some cases, the promoter may use complex structures to hide the true nature of the investment or to avoid detection by regulators or law enforcement. Another common offshore investment scam is the Ponzi scheme. In a Ponzi scheme, early investors are paid with the funds of new investors, creating the illusion of profits and attracting more investors. However, these schemes are unsustainable and may eventually collapse, leaving many investors with significant losses. Investors should be cautious when considering offshore investments and should research the investment thoroughly before committing any funds. They should also be wary of investment opportunities that promise high returns with little or no risk, as these are often too good to be true and may be signs of a scam. Finally, investors should ensure that any investment they make is regulated by a reputable authority and that they understand the risks involved. 5. Affinity fraud. Affinity fraud is a type of investment scam that targets members of a particular community, such as a religious or ethnic group, or a professional network, such as a group of doctors or lawyers. The fraudster may be a member of the same community or network and may use this connection to gain the trust of potential victims. In an affinity fraud, the fraudster typically presents an investment opportunity that is supposed to be exclusive to members of the community or network. The investment may be in a legitimate business or may be a completely fictitious scheme. The fraudster often uses testimonials or endorsements from other members of the community or network to create a sense of trust and legitimacy. The problem is that affinity frauds are often fraudulent, and the promised returns are either exaggerated or completely fictional. The fraudster may use the funds raised from new investors to pay off earlier investors, creating the impression that the investment is generating high returns. However, as more investors are brought in, the fraudster may flee with the funds, leaving investors with significant losses. Affinity fraud can be difficult to detect, as the fraudster may be highly trusted within the community or network. Investors should be cautious when considering investment opportunities that are presented within their community or network, and should research the investment thoroughly before committing any funds. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.